what's up, everybody? It is Friday. Whoa, TGIF. Thank God it's Friday, really. What a week. Our market had a rough day today. I'm going to try to break this all down as best I can. I mean, clearly the big event of the week, the big boulder thrown into that still water pond was the Fed on Wednesday. And I just went back and looked at my MMT trader report that came out on Monday, and the headline was, will the Fed surprise the markets this week? And boy, was that prescient. Let me try to break this down, and I've been trying to explain this over the last few videos. So, between the Fed and the Treasury, the Fed buying $120 billion a month in assets, that's adding reserves into the banking system. Treasury having to draw down its account, or intending to draw down its account, so this, the spending of money without the offsetting sale of treasuries or other securities to drain. You can really see now how, it's not borrowing. That is a necessary function to keep reserves at levels that are manageable. Everyone should be able to see this right now. Without these treasury sales at the level, where they should be to keep reserves manageable, we're in this big mess. But anyway, so leading up to this, of course, the Fed was saying, hey, we're not going to raise rates. We're not going to raise rates. We're not going to raise rates. I've been saying that. I've been saying, look, they tell you what they're going to do. Unfortunately, this time on Wednesday, they didn't give us any heads up whatsoever. At least back in the day when Yellen was running the Fed, I remember when the Fed was going to reverse policy, they said months in advance, a couple of months in advance, in December 2015, we're going to start to raise interest rates. So you knew what was going to happen. They told you. All right, so anyway, all these reserves piling up under the current regulatory structure. Now we know this. We've been through this, remember, back in March with the leverage ratio, the SLR, and there was an exemption on that for a year where treasuries and reserves were not included in the calculation of the leverage ratio. But then, so that was suspended. But then at the end of March, that was coming up for renewal. They didn't extend that exemption, and the constraint went back into effect. So here's the Fed piling on all these reserves into the banks. Here's the Treasury spending down its account, more reserves piling on to the banks. The banks can't take deposits, or they're limited in how they're taking deposits. The money's being shunted off into money market funds. And those money market funds and the banks are parking excess reserves at the Fed. Meanwhile, all these reserves were putting pressure on short-term rates. They're starting to go negative or approaching negative. The Fed thinking, hey, we gotta defend our policy rate. So they came out on Wednesday and they raised the interest paid on excess reserves by 0.05. Now that doesn't seem like a lot, but it triggered off a range of, or an adjustment in expectations. Then you had, the dot plot, which said, or, it was a forecast by Fed members. Now there's going to be 2 rate increases in 2023. Fed fund futures starting to price in a rate increase next year, at the end of next year. Actually by March, I think. Today you had Bullard come out. Who is he? Is he the Chicago Fed? I don't remember. Anyway, Bullard comes out and says he'd raise rates next year. That tanked the market. So here's the problem. You got the Fed still adding reserves with these $120 billion in assets. you got the banks and the financial system under the leverage ratio constraint where they're getting all these reserves and they can't handle it. They have to pass it off into the Fed. Rates were going down negative. The Fed raised the overnight rate to try to, put a floor under that. The Treasury has to reduce its balance by July 31st in order to conform to the law they passed 2 years ago with respect to the debt ceiling. Now, the debt ceiling plays into this as well. I mean, the debt ceiling is a big problem. Treasury now has to bring its balance down. It's not able to issue more securities because it's under the constraint of the debt ceiling. So you have all these things. This is like a gigantic train wreck, man. And basically, this stuff can be alleviated very simply with a regulatory tweak. I mean, they could suspend or eliminate the use of treasuries or the inclusion of treasuries and reserves in the leverage ratio. Those are risk-free assets. They should take them out. Total mismanagement. And the thing is, again, you had Powell for months and months and months saying no rate increase, and boom, then it happens out of nowhere. So it's a gut punch to the market. It's a shock to investors because it plays with that reaction function of investors where the Fed sets that reaction function. By the way, it just goes to show you what has happened in the last 2 days, that the Fed really doesn't have to do very much. All it has to do is talk and rates adjust. I mean, just this simple, hint or suggestion that they might raise rates, all the way 2 years from now, you see the market adjusting to it right away. So anyway, the one thing I told you on Wednesday was that, actually I said it on Tuesday, I said if we did get a reaction in the bond market down, I said to buy that. And that has worked out very well. Now, here's the other thing. So far, I don't see any slowdown in the fiscal flows. However, and that even includes unemployment benefits. If I look at average daily unemployment benefits this week, and this week, remember, 4 states have already opted out of the enhanced unemployment benefits. When I look at the benefits for this week, average daily unemployment benefits, it was like 1.95 billion a day. That compares to the prior week when, all the states were receiving the benefits. That was 1.64 billion a day. So benefits payments actually went up this week, which is interesting. Now, I don't think that's going to be sustained because, now next week we're going to have more states. I think something like could be 11 states next week are out of the program. Okay? They've opted out. Today was the last day. So we could definitely see something. And one more thing, which is kind of concerning. I looked at the deficit today. The deficit was 2.15, call it 2.15, it was 2.146 trillion. This is the first time the deficit right now is actually below where it was at this time last year. Now, the deficit year over year has been narrowing for the last, 2 months because, last year at this time we had that big ramp up of fiscal stimulus because of the COVID, the initial stimulus because of the COVID. So it's natural to see the two deficits converge. But we still were up this year compared to last year. You follow me? Now we just flipped down this year. So in other words, the deficit this year, 2.146 trillion, is below where it was last year. I think it was like 2.1 5 trillion or something. It's about a 22 billion difference. It doesn't seem like a lot, and it's not a lot, when you're talking about numbers of that size. The important thing is it flipped negative year over year. And if it stays negative year over year, that would be the first time in 5 years that the current deficit was lower than the prior year's deficit. So what does that mean? It means, this is very important. Deficit is very important because I've explained this to you many times. The deficit is the net addition to the financial balances of the non-government, right? If the government runs a we'll call it 2.2 trillion deficit, by definition, the non-government, that's us, everybody who's not the government, has increased, the financial balances of the non-government has increased by 2.4 trillion. So what does it mean if it goes down year over year? It means the net addition to the financial balances is slowing down. Don't want to see that. Don't want to see that. Okay? That's what's happening. I said big things were coming, man. Go back and watch my video from a couple of weeks ago or a week ago. I said big things are about to happen. And so here we are. Anyway, I'm happy it's Friday, man. We'll see what happens next week. All we need really is the passage of another stimulus. I mean, if we get another stimulus, if we get the infrastructure, everything's back on track. 100%. But you're dealing with politics, and it's very, very partisan right now. So I don't know if we should necessarily expect those things to happen. Anyway, have a great weekend. If I can, I'll update you over the weekend. Take care. Bye.